The allure of growth stocks is undeniable. The promise of rapid expansion, market dominance, and exponential returns captivates investors, drawing them toward companies poised for exceptional performance. But beneath the surface of impressive revenue figures and innovative products lie potential pitfalls, risks that can undermine even the most meticulously crafted investment strategy. Are you truly seeing the full picture, or are you only captivated by the dazzling highlights? Growth stock screening, a seemingly objective and data-driven approach, is often embraced as a reliable method for identifying these promising opportunities. Yet, relying solely on readily available metrics can be a dangerous game. What if the numbers, so seemingly clear, are actually obscuring a deeper, more complex reality? What if the algorithm is blind to the nuances that truly determine a company's long-term viability? This isn't about dismissing growth stocks altogether. It's about equipping ourselves with the tools and the mindset to navigate this exciting yet treacherous landscape. We need to move beyond the superficial and delve into the hidden dimensions of risk that often go unnoticed. We are uncovering the hidden truths behind wealth accumulation. Our objective here is simple: to shed light on the critical, yet often overlooked, risks inherent in growth stock screening. We will move beyond the headlines. We will challenge the consensus. Find your edge. By understanding these hidden dangers, you can make more informed, more resilient, and ultimately more profitable investment decisions. Benjamin Graham, the father of value investing, wisely stated, "The intelligent investor is a realist who sells to optimists and buys from pessimists." This sentiment serves as our guiding principle. It is a call to approach growth stock screening with a healthy dose of skepticism, a contrarian spirit, and an unwavering commitment to data-driven analysis. Don't just invest, understand the why behind every decision. Let's begin to uncover the complexities that lie beneath the surface. The siren song of rapid revenue growth can be intoxicating. It's easy to be swept away by impressive top-line numbers, believing that explosive sales automatically translate into long-term success. But what if that growth is fueled by unsustainable practices, by sacrificing profitability for the sake of expansion? Is your diversified portfolio truly diversified? The reality is that growth at any cost is often a mirage, a fleeting illusion that masks underlying weaknesses. Data reveals a sobering truth: a high revenue growth rate doesn't guarantee profitability. In fact, many growth stocks exhibit precisely the opposite pattern: soaring revenues coupled with negative earnings or dwindling cash flow. Look beyond the headlines. What's really driving the market? Revenue, in and of itself, is not an accurate measure of a company's true worth. It's merely one piece of the puzzle. We must consider profitability, the lifeblood of any sustainable enterprise. We must scrutinize cash flow, the fuel that powers future growth. And we must evaluate return on invested capital, the ultimate measure of efficiency and value creation. So, how do we discern genuine, sustainable growth from the deceptive allure of growth at any cost? We must dissect the quality of revenue, analyze gross margins. Are they expanding or contracting? Examine customer acquisition costs. Are they escalating to unsustainable levels? Scrutinize customer retention rates. Are customers sticking around, or are they fleeing to competitors? Sustainable growth is a delicate balance, a harmonious blend of revenue expansion and robust profitability. The intelligent investor seeks companies that are not only growing rapidly, but also demonstrate a clear and credible path to long-term financial prosperity. Don't be seduced by the mirage. Focus on the substance beneath the surface. Momentum investing, the strategy of riding the wave of rising stock prices, can be incredibly alluring. Witnessing a stock surge in value day after day fuels a powerful sense of excitement and anticipation. But this very excitement can blind us to the underlying risks, leading us into a dangerous momentum trap. We are uncovering the hidden truths behind wealth accumulation. At the heart of this trap lies recency bias, a psychological quirk that causes us to overemphasize recent events while downplaying historical data. We extrapolate recent performance into the future, assuming that the upward trend will continue indefinitely. This is a dangerous assumption, especially in the volatile world of growth stocks. Data reveals that momentum stocks are particularly susceptible to overvaluation. As prices climb, driven by investor enthusiasm, they often detach from fundamental value. When growth inevitably slows, or when expectations are not met, the resulting price correction can be swift and brutal. Beyond the headlines, what's really driving the market? How do we avoid this treacherous trap? We must anchor ourselves to the bedrock of fundamental valuation. Implement a valuation screen, employing metrics like price-to-earnings (PE), price-to-sales (PS), and discounted cash flow (DCF) analysis. Ensure that the stock price is supported by tangible fundamentals, not just fleeting hype. The momentum trap is akin to chasing a mirage in the desert. It promises refreshment, high returns, but ultimately leads to disappointment, losses, when the underlying reality, overvaluation, is revealed. Don't just invest, understand the why behind every decision. Remain grounded in value and resist the seductive pull of momentum alone. The world of accounting can be complex and opaque, a landscape where companies sometimes employ financial engineering to present a distorted picture of their financial health. These techniques, while technically legal, can mask underlying weaknesses and create a dangerous illusion of prosperity. Is your diversified portfolio truly diversified? Growth companies, under pressure to maintain high growth rates, are particularly susceptible to manipulating their financial statements. Aggressive revenue recognition, capitalizing expenses that should be expensed, and utilizing off-balance sheet financing are just a few of the tricks employed to inflate earnings or revenues. We are uncovering the hidden truths behind wealth accumulation. History is littered with examples of growth companies that have fallen prey to the allure of financial engineering. These accounting scandals, often exposed after years of deception, invariably lead to stock price collapses and shattered investor confidence. Look beyond the headlines. What's really driving the market? How can we, as intelligent investors, detect these deceptive practices? We must become forensic accountants, meticulously analyzing a company's cash flow statement, scrutinizing related party transactions, and comparing accounting ratios to industry peers. Look for inconsistencies, anomalies, and red flags that suggest something is amiss. The financial engineering illusion is akin to building a house on sand. It may look impressive on the surface, but it lacks a solid foundation and is prone to collapse under pressure. Don't just invest, understand the why behind every decision. Develop a keen eye for detecting accounting shenanigans and protect yourself from the devastating consequences of investing in companies built on illusion. The promise of industry disruption holds an undeniable allure. The idea of a company revolutionizing a traditional sector, overturning established norms, and achieving exponential growth is incredibly exciting. But this excitement can cloud our judgment, leading us to invest in companies that are more hype than substance. We are uncovering the hidden truths behind wealth accumulation. The industry disruption narrative is particularly potent because it taps into our deepest desires. Dopamine, the reward for learning and discovery, fuels our fascination with innovative companies. Serotonin, the sense of control and mastery, reinforces our belief in their potential. Even cortisol, the stress hormone, plays a role, as challenging our existing beliefs can lead to greater engagement. These hormones might hinder your empowered, data-driven decision-making. However, data reveals a sobering truth. Many so-called disruptive companies fail to achieve sustainable growth or profitability. They often face intense competition, struggle with changing consumer preferences, or encounter unforeseen regulatory hurdles. Is your diversified portfolio truly diversified? Therefore, how do we separate true innovators from fleeting fads? We must rigorously assess their competitive advantages, evaluate the size of their addressable market, and analyze the barriers to entry that protect their position. A truly disruptive company possesses a sustainable competitive edge, a clear path to profitability, and the ability to withstand the inevitable challenges that lie ahead. Don't just invest, understand the why behind every decision. Differentiate between genuine innovators with enduring advantages and passing fads driven by hype and speculation. Challenge the consensus. Find your edge. Only then can you harness the power of industry disruption without falling victim to its seductive, yet often misleading, narrative. The four risks we've explored: growth at any cost, the momentum trap, financial engineering, and industry disruption hype are dangerous enough on their own. But what happens when they converge, when they overlap and compound, creating a perfect storm for growth stock investors? We are uncovering the hidden truths behind wealth accumulation. Imagine a company pursuing aggressive revenue growth through unsustainable means, inflating its earnings with accounting tricks, riding the wave of investor enthusiasm, and claiming to disrupt a traditional industry. This is not a hypothetical scenario. It's a recipe for disaster that has played out time and time again in the financial markets. Look beyond the headlines. What's really driving the market? History provides ample case studies of growth companies that have experienced a combination of these risks, leading to significant losses for unsuspecting investors. These cautionary tales underscore the importance of conducting thorough due diligence, diversifying investments, and remaining vigilant against the seductive allure of hype and speculation. Is your diversified portfolio truly diversified? To navigate these treacherous waters, we need a practical tool, a compass to guide our investment decisions. Consider developing a checklist or scoring system that evaluates growth stocks based on these four risk factors. This will help you quantify the potential dangers and make more informed, data-driven decisions. The perfect storm scenario is akin to a ship navigating treacherous waters. A combination of hidden reefs, strong currents, and unpredictable weather can lead to disaster if not properly anticipated and managed. Don't just invest, understand understand the why behind every decision. By recognizing the potential for these risks to overlap and by implementing robust risk management strategies, you can protect your portfolio from the devastating consequences of the perfect storm. Navigating the world of growth stocks can feel like traversing a minefield. The potential rewards are immense, but the risks are equally significant. We've explored for hidden dangers that often lurk beneath the surface: the illusion of growth at any cost, the seductive pull of the momentum trap, the deceptive practices of financial engineering, and the overblown hype surrounding industry disruption. It's easy to be swept away by the excitement and optimism that often accompany growth stocks, but as intelligent investors, we must resist the temptation to blindly follow the crowd. We must embrace a data-driven approach, meticulously analyzing financial statements, scrutinizing competitive advantages, and questioning the underlying assumptions that drive market valuations. Challenge the consensus. Find your edge. Remember, sustainable wealth creation is not about chasing fleeting trends or blindly following the herd. It's about making informed decisions based on sound analysis, disciplined risk management, and a healthy dose of skepticism. Don't just invest, understand the why behind every decision. We are uncovering the hidden truths behind wealth accumulation. By understanding these hidden risks, by adopting a skeptical mindset, and by embracing a data-driven approach, you can navigate the growth stock minefield with greater confidence and achieve long-term financial success. Look beyond the headlines. What's really driving the market? Warren Buffett, the Oracle of Omaha, wisely advised, "Be fearful when others are greedy and greedy when others are fearful." This timeless wisdom encapsulates the essence of intelligent investing. It's a call to think independently, to challenge conventional wisdom, and to remain disciplined in the face of market euphoria or despair. Now, armed with this knowledge, how will you approach your next growth stock investment?